I'm Charlotte McLeod with the Investing News Network, and here today with me is Adam Rozencwajg, Managing Partner at Goehring and Rozencwajg. Thank you so much for joining me online once again. It's great to see you.
Great to see you as well. Happy to be back.
Yeah, so happy to be back with you as well. And we're, I think, going to pick up on our conversation that we had previously. The last time we spoke was back in March. That was just after the Russia-Ukraine war had begun. And we were talking about what that meant for the energy situation, because that conflict was basically getting a lot of credit for causing this energy crisis over in Europe. But one of my takeaways from what you were saying is that this was something that had been building for quite some time due to lack of investment in energy over the past decade, really. So one of the things that I want to check in with you about now is that lack of investment. Are we starting to see changes around the world? Are governments starting to take a look at this and say, okay, we really need to address this? Are we seeing that? And if so, where?
No, I think the short answer is absolutely not. I think most governments and most administrations around the world seem to be doubling down on their need for renewables, which unfortunately is one of the things that led us into this situation, right? We took all this money away from the oil and gas sector and put it towards renewables, hoping that that could fix our energy problems, and it really didn't. It made them a lot worse. And now the solution is more of the same. And so unfortunately, we haven't really seen much by the different administrations. But it's so funny. And funny is not the right word, but here we had a very difficult energy situation developing before the Ukraine war. And then I said, we have to be careful mixing up what's happening in the Ukraine with the fundamentals that already were in place. And now here we are 6 months later, and prices are back to before the Ukraine war situation, even though we still have the war in the Ukraine going on. So it's sort of like, the price spike wasn't Ukraine driven, and now we still have all of those stressors in place, and the price is even cheaper than it was before. So I think investors here have been given an unbelievable opportunity to potentially add or establish some energy positions before what I think is going to be a very difficult winter.
Yeah, I mean, we keep hearing about this tough winter that's coming, right? And there's a lot to cover if we are going through what's happening in energy. I want to start with oil and gas and kind of ask you if you see that right now as more a demand side story or a supply side story, because I can see elements of both, right? In terms of demand, we've got all kinds of problems. And in terms of supply, also problems like the US drawing down the Strategic Petroleum Reserve. I know you've talked about spare capacity issues. So where are you seeing it from?
So look, I think right now we're in a really clear supply situation. We have just underinvested in this industry for so long, and it's starting to have real implications and real ramifications. So, oil prices today in the US, they've pulled all the way back down to 85, which I should point out is still a very, very healthy price compared to any point over the last couple of years. But, down from 120, we haven't seen any response by any of the producers to really increase their activity or increase their production. The shales, which had been driven all of the global growth pre-pandemic, has been very, very slow to come back, just like we kind of predicted it would. It's been very disappointing in that regard. Meanwhile, inventories around the world are super low. We have been releasing 1.5 million barrels a day from the Strategic Petroleum Reserve. That's a huge amount. That's as much as the shales grew in their peak growth years, and we're releasing that from the SPRs, and still inventories are declining when you factor in the SPR. And then you have to deal with now the two very, very concerning issues going forward, which is that OPEC has agreed to cut production by 2 million barrels a day. And we're going to be sanctioning Russian crude at the end of this year. So none of these things have happened yet. This is all looking out in front of us. And yet the price of crude has come down, even though inventories are really, really cheap. And I think that's because the world is worried about demand, and the world is really worried about looming recession, potentially even, more than that, potentially even a real dislocation. But the truth of the matter is demand is not what's going to drive this market. Markets tend to be driven by the supply side or the demand side at any given time. And in The last cycle in 2003, it was all about demand, and now it's all about supply. And until we fix that, we're not going to see any change in this problem.
So you mentioned where we are in the cycle. I'm curious to hear your thoughts on that because it feels like everything is kind of wonky and upside down and all these different factors. What is your sense of that?
Yeah, I think this is really the calm before the storm. I think we had a bit of turmoil in the energy markets earlier this year. Prices, in crude basically exceeded 120 twice, first in March and then again in June before beginning their sell-off. If you look at US natural gas, gas prices topped out at 9.50 and now they're down to $5 today. And natural gas prices in Europe, which topped out around 90, are down to 35. And in a very real way, nothing has improved here. Nothing has gotten the slightest bit better. And so I think what you're really seeing is a little bit of calm before the storm. Inventories continue to ratchet down in global crude markets. We've become completely addicted to the SPR, and all that's going away in the next several weeks here. So, I think in that regard, the fundamentals paint a very bullish picture. In the natural gas market, it's maybe a little bit more complicated. There had been a very, very acute worry that Europe was going to run out of gas going into this winter, and that there would be, a bit of a calamity as the temperature started to drop. And I think that's still very much a risk. But one thing that has happened has been that Europe has replenished its natural gas inventories ahead of the winter. And it's funny because, I have people that we called for a tight gas market for some time. And I have people that call me and say, well, what do you say now? Europe has really filled up their inventories. I say, thank God that they did that, because that's really the only thing that's going to be able to protect them this winter. But if you think we're out of the woods, you're just not looking at this market properly. So what do I mean by that? Well, how did Europe refill its inventories? It did it in a couple different ways. The first thing that it did is it basically shut down all of its industry. Not all of its industry, but about 20% of industrial capacity has been furloughed and curtailed in Europe right now. I mean, that's pretty draconian. That's not a really good situation to be facing. Second was that Germany in particular has burned a tremendous amount of coal, and they've actually been burning quite a bit of wood as well to try and get themselves off of the need for Russian gas, that they could put as much into inventory as possible. But then the third thing that people don't really appreciate is that Russian gas has been flowing until very recently. So yes, they filled their inventories back up, but they did that with Russian volumes by shutting down their industrial base and by turning to things as archaic as wood. So, I don't know why this is considered such a great victory. It leaves them still very precarious, particularly because Russia has now basically shut off the gas to Europe. So, people again think we have all this inventory, so we'll be awash in gas. They don't realize that in the winter months, you consume gas that comes in via pipeline, and you draw down inventories because the pipeline's not enough. So yes, you have your inventories, but you've shut off your pipeline. So how long will those inventories possibly last? And that's where you can get some really scary pictures that you'll have to shut, 35, 40% of European industrial capacity by the springtime if you want to have any gas left at all. So where does that leave poor Europe? I mean, it really, unfortunately, I hate to say this, it comes down to the weather. And I think that that's really an unfortunate situation to have to find yourselves in 2022, where we've made, progress in all fronts and medicine and this and that. And, Europe's burning wood and hoping and praying for a warm and mild winter. They don't get it. It's going to be really, really tough for them. So look, I think that there's things that have, you know, uh, 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 improved, and I'm happy that they have. But we are not out of the woods yet. We have a very tight energy market. The cause of the tightness is underinvestment for 10 years. That's not changing. You're still diverting money from oil and gas into renewables and biodiesels and things of that nature that just have very, very low yields and high capital intensities. And until you fix any of those, maybe weather saves you for a while. Maybe you get another slug out of the SPR, but these aren't long-term solutions to the problems, and they should be used as buying opportunities by investors.
Yeah, let's talk a little bit about the investor angle as well, because I think what a lot of you are saying makes sense. People see these fixes come in and they think, Okay, it's done. I don't need to look at this anymore. But you've been mentioning to us, this is a big opportunity. I know in the past when we were speaking about oil and gas, you mentioned high quality US and Canadian names. Is that still where you see opportunities right now? And how, as an investor, do you approach this in terms of timing, perhaps?
Yeah, no, I think that that is still how we're looking at it. These names are not so expensive on any metric. They're in fact remarkably cheap that I don't think you really have to, you know, look out and get too complicated and things like that. We favor high quality. We favor U.S., but you could do Canada as well. And we favor to stay away from the large integrated companies like the Exxons and the Chevrons of the world, just because I think they have a target on their back by certain governments, administrations, and things like that for supernormal profits and for divesting of businesses and whatever. We still see a lot of pressure there. So I think that for the time being, you're best off still with names like the Pioneers of the world, or the Matadors of the world, or Diamondback. And I know you have a lot of Canadian viewers. We don't own any Canadian names, so I'll refrain from talking on any of them. But there are some good Canadian names as well, and we look at those very closely, and they represent really good value too. So there's a lot of good opportunities out there, and we do favor still the high quality independent, yeah, E&P producers. And they're down off of their highs, but they've actually started to show more resiliency compared to the energy price. So if you look, the XOP, which is the S&P Oil and Gas Exploration and Production ETF, that topped out at about 75% in the end of May, but it's still up, 60% for the year, 55% for the year, against a market that's obviously down strong double digits. So, there's actually, I think they're showing a little bit more resiliency than actually the energy price in general.
Okay, okay, thank you for that. I also want to make sure that in addition to what's going on in oil and gas, we look at uranium. So we've talked about uranium before, but the last time we did was really about a year ago. So at the time, we were talking about how this has been a neglected market. It was starting to gain some traction. And I think in the last 12 months, it is something that really has picked up. People are looking at it more and more. So we talked about where oil and gas is in its cycle. What about uranium? Where do you see that having developed to at the moment?
Yeah, look, I think uranium stocks this year have been under pressure. They've been kind of flirting with break even. There's been times where they've been up as much as 20% and down as much as 20%. Right now, they're about down 10 for the year in US dollar terms. But they have very much sort of come into the forefront. And what I mean by that is, there's been a lot of discussion about the importance of nuclear power as part of energy policy, and the idea that you can use nuclear as base load carbon-free power, which you absolutely can. It's in fact the most energy efficient form of energy out there. It consumes the least amount of energy per unit of energy produced out of anything by a wide margin. So it's a wonderful source. It's incredibly safe. And, Canada's right at the forefront, both in terms of its reactor designs and in terms of, most importantly, its big uranium deposits. And so, when we start to look, particularly in the US, I'm Canadian originally, but I've lived here for a long time. People are talking more and more about where their commodities are coming from, and particularly in the uranium side of the business, there's a lot of concern about where your uranium and your enriched uranium come from. And unfortunately, a lot does come from Russia. We can make do without Russian oil. It'll be hard, and we'll have to deal with higher prices. We can make do without Russian gas. It'll be hard, but we really can't make do without Russian upgraded uranium, enriched uranium. And that's something I think that's starting to scare a lot of folks. And so the idea of domestic supplies, and I'll lump Canada in with the U.S. there, domestic friendly supplies of uranium and enrichment becomes really, really, really important. Now the flip side is that this is not a 2022, 2023 story in terms of getting these things spun up, put up, and built and operating. This will be a 10-year build, but you also don't need a huge amount of new demand to make a bullish case for the price of uranium, because we've underinvested in that. Worse than anything, we haven't brought on a new uranium mine in 30 years. And so you look at how low the price got in uranium, and poor Cameco and Kazatomprom, they had to shut down their production. These are, you have a duopoly. Two companies in the world really produce uranium, and even they couldn't make money. I've never quite seen anything like that. I thought they're supposed to have a little bit of pricing power, but even they weren't able to hold their price. So the fundamentals look really good today. But what's going to drive the stocks, I think, is how investors think about the uranium industry, nuclear power business. And that's starting to get better and better. But we won't see these new Western nuclear reactors really come online for a number of years. So the story is going to be on the demand side about China for the next couple of years. And that's fine. That's enough to carry the day. So we're still huge uranium bulls. Excuse me. We think that the stocks here represent good value because they really haven't done too much this year. We're starting to see exciting things begin to happen, announcements be made. We're starting to see, obviously, Cameco had the big announcement where they're teaming up with Brookfield to buy the Westinghouse assets. We're starting to see really, really exciting news on the small modular reactor technologies start to move ahead, which we've done a lot of studying about, and we think that there's some really promising technologies there. Particularly what Bill Gates and his outfit is doing out in Washington State is really exciting, and I think has a really bright future for nuclear power. So I'm actually really optimistic about energy, and I'm optimistic because I think that perhaps this crisis will actually make people realize what a wonderful technology nuclear power truly is.
It definitely seems like we're heading in that direction. And as I keep saying in my conversations about uranium, you kind of rattled off a whole list of things that have really happened quite recently that look very positive.
Yes.
I think that, yeah, I think that people are watching prices very quickly or very closely. And I wondered if there's anything more you can say about that, because that relates to when we see more production come online. So do you have anything you can say about the trajectory there?
Yeah, look, the thing with uranium prices, and I think as Canadians, you guys all get this, is that when uranium prices go, they can really go. And the reason for that is that once you spend, $6 billion building a gigawatt or 2 gigawatt nuclear reactor, big, big, big projects, huge capital costs, very efficient though, once they're up and running. So the cost of your nuclear fuel to that whole project is actually quite low. The one thing you really can't let happen is you can't let your reactor go idle. So, you're out there, you're a captive buyer. Now it's worked in reverse for the last couple of years and it's driven prices really low, but I think it can really result in an extremely strong move. So, where's uranium today? It's, in the high 40s, low 50s, depending on who you ask. Last cycle, it made a high of 150 bucks. But you know what? $150 didn't really bring on any new mines last time either. Right. The reason that bull market ended was because of Fukushima. So how high could prices go this time? I mean, really anyone's guess. And once they start moving, it could be really quite violent. So, back in the 1960s, you had a bull market mania in uranium stocks. Nobody really remembers that. You have to go back and read the history books. You had another one in the late 1990s, and this could be the third, but they can really, really move if they do. So, you know, the trajectory looks good. You have Sprott that's now out in the market. They're buying physical uranium to put in their uranium trust. That's put a nice bid into the market. And the buyers, from what we hear, the physical uranium buyers are starting to get nervous. They start to see the fact that perhaps we do have a new nuclear renaissance. Maybe there's going to be new fuel buying starting in 26, 27 for 2030. That only leaves them a year or two to try to cover their long-term commitment. So I think that the price trajectory can move a lot higher. I think that the sentiment, though, has really, really changed. And so this will be a near term, it'll be a developing market story. China is unrolling a huge number of new nuclear reactors in the next few years. So is India. So Saudi Arabia is considering as well. And then you start to come into the idea that the Western world is moving back towards nuclear power by the end of this decade. And so I think, we're going to have to recapitalize this industry. Nobody knows who Cameco is. I can't tell you the number of people, if you go back more than a year ago, they thought we owned Caminco. And I say, well, no, Caminco's not around anymore. It's actually a different company. Has nothing to do with Tech Caminco. This is Cameco, the world's second largest uranium company. Kazatomprom was state owned until I guess 2.5 years ago now. So, this is a fast developing market. There's not a lot in the way of new projects. There's a few juniors out there. They're starting to move. And I think there's a very exciting time ahead for the uranium mining companies going forward.
Okay, yeah, it certainly looks that way. And I remember when we talked before, you mentioned that you're looking at the larger companies like the Camicos. And And the Sprott Trust, I believe, is one that you also mentioned. So I wanted to check in with you on that and see if that's still where your focus is. And maybe we could also talk about this new Cameco deal, because I know people are very interested and excited about that. I'm kind of understanding it as a vertical integration type of thing, but maybe you could share your perspective.
Sure. So a couple different things. When we had last spoken, we said, look, the way we try to think about investments that we make is we say we have a view on where prices are going, and sometimes that view is quite high, sometimes it's not, and so we don't mind using that view to inform how we value our companies. But we want to make sure that if we're wrong, they're still worth something, that they're not effectively getting bailed out by a higher commodity price, but in fact they can take advantage of it if it does happen, but there's some value there if they don't. And so the problem with some of the smaller development stories when uranium was $30 or as low as 19, but even when it was as 30, you couldn't make an economic case for a lot of them until you knew that you were going to be really probably at 75. People might argue with me on that, but that's our view anyway. So as the prices move higher, it's not that you want to wait till you get to 75, because then you'll have lost a lot of value. But you also don't want to have uranium at 22 and say, well, it only has to go up fourfold for this project to make sense. That seems a little bit daunting and scary. So we made the house view, that as prices moved and as the rally seemed like it'd be more sustainable, we would look to some of the more high quality um, junior development stories that were out there that would be the first ones to actually get sanctioned and go ahead. And so we've done that. We're not fully through that process yet. But we have done that to a certain extent. And as everyone knows, if uranium does go to $150, it's not going to be Cameco that goes up the most. It's going to be some of these really small junior names. And so we just kind of want to make that right balance as the bull market carries on. So right now we have some exposure still to Cameco and Kazatomprom. We still have some exposure to the uranium, the Sprott, what I used to call the Uranium Participation Unit, but now I guess it's the Sprott Physical Uranium Trust. But we've added a couple names as well. We've added NextGen. We've added Denison, as well as some of their operational test results have come in really, really positively. They're doing this whole freeze dome technology and a freeze wall. And at the beginning, we said, oh my goodness, that sounds awfully complicated and difficult. But they've had some good results there. And as a result of that, we were in a position to say, okay, we want to be involved. So we have some positions there as well. So we're starting to broaden that basket a little bit. Some of this stuff is art as well as science. If uranium pulls back terribly, we'll say, oh, we should have waited a little bit. And if uranium prices move just higher and higher and higher in a straight line, we'll say, oh, we should have bought all the small junior guys. So you kind of want to be a little bit split the difference, and that's kind of where we are right now.
Okay, I think that makes sense, that gradual approach as the price goes up. So, as we're kind of finishing up here, we've talked about different elements of what's going on in the energy sector. We've gone through oil and gas, we've looked at uranium. These are pretty popular sectors. But you also alluded to, some of the clean green energy types of things like wind and solar. They're part of it. And I wondered if you could kind of situate those in the mix, and also like perhaps coal, because as you mentioned, we have countries over in Europe that are needing to use it because of the whole Russia-Ukraine situation. So what about these other elements of the market that maybe we don't talk about quite so much?
Sure. Look, I unfortunately, and we said this often and vocally, I think that wind and solar have a lot of really big challenges. I think they're extremely energy intensive forms of energy. You look at the, new 4.5 megawatt wind turbines, and those things are going to stand the height of a 30-story building and require 700 tons of steel and 2,200 tons of cement per windmill. And you take 6 of those windmills and you get to the same amount of energy as a single Permian oil well. So these are not the same order of magnitude in terms of energy efficiency. And the problem is that we have never fully accounted for that. We've had cheap, abundant energy for the last 10 years because of the shales, and before that a little bit because of the oil sands as well. But we're running out of that cheap energy now, and so we have to, I think, be a little bit more conscious. So we've been really, really vocal in the idea that wind and solar, I don't see them as part of our energy solution. Now, I do think that we have a carbon problem. I don't think that CO2 emissions should be taken lightly. I think if we're being honest, some of those questions of CO2 are probably a little bit more complicated than we care to put them. Some people either say there's no problem or there's this huge problem. I tend to think there is a problem with CO2 and man-made global warming. However, I think it's a very complicated issue with feedback loops that no one on either side is interested in addressing. Be that as it may, wind and solar just won't get us there. And so if we are concerned about this stuff, and we are concerned at all with, avoiding revolution and revolt, we're going to have to come up with something that is both energy efficient and carbon efficient, or low CO2. And nuclear fits that bill. And so, I think that it's a little bit of a false narrative to have to choose between oil and gas and wind and solar, or choose between economic development and the environment. The answer is staring us in the face. And if we just can appreciate it, we'll all be much better off, both environmentally and economically. So I don't think that wind and solar are really part of the solution. I don't think that they're at all part of the solution. And I think the faster we admit that, the better off we'll all be. Coal, I'd love to see us all move away from coal towards something that's cleaner and more efficient. We do have something that is just as efficient as coal and half the CO2, and that's natural gas. And so I think we should be moving towards natural gas. The problem is we have a little bit of a natural gas crisis right now, notably in Europe. So to say, look, the world's fixed, let's just go to gas. You could have said that 3 or 4 years ago and then invested behind it and brought on the gas supply to meet that demand. But now we've let it go too far. And so unfortunately, coal is coming back into the mix. It is a reliable source of base load power, but it does emit quite a bit of CO2. So we've actually made some coal investments because I do think that that unfortunately, for the environment's perspective, we're going to need it longer than we would have if we'd just been more sensible with our gas policies. But I think long term, it's not a winner, and I think that gas and nuclear win out over that.
Yeah, well, and this is certainly a theme that I've been hearing among people for coal or even oil and gas, people saying, wow, it turns out we're going to need them for longer than we thought. So we're going to look at that. So it makes sense, perfect sense to me. I think that's everything I have, unless you had any final thoughts, things that are on your mind right now.
Well, the big thing that we're watching really closely and getting more and more excited about, because it's just getting cheaper and cheaper, is something we didn't talk at all about today, and that's gold. So I'll leave that as a tantalizing, preview for next time if you want, for your Canadian investor base. But gold is just looking awfully cheap here, and it's working so poorly in the last 6, 8 months. People are saying, gold prices are down despite inflation making 40-year highs, and this was supposed to be the big moment that gold investors were waiting for. My personal feeling is, just wait. I think gold's moment is out in front of it, and I think there's a huge bull market, but it is certainly not working for the moment. Gold stocks neither. So, we're maintaining our energy exposure, but the value investor and the contrarian in us, is sort of champing at the bit a little bit, wanting to get involved here in the gold market at some point. So the moment's coming. I think it's coming quicker. We're obviously getting closer than we had been. But man, oh man, it's been awfully frustrating to be a gold investor for the last year or so.
Okay, we'll certainly come back to that. I would love to hear more on you from gold. So we'll come back to that. Thank you so much for coming on to talk today, though, about energy. I think this was really useful in explaining the situation for investors.
Great, always nice to talk.
Yes, very nice. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Adam Rosenzweig with Goehring and Rozencwajg.